Carlden Lainfiesta, the Mortgage Fiesta here, talking to you about a 5% down product that is going live with my bank this week for 2 to 4 units, okay? So those of you who are looking for ways to save on your monthly payment, you might want to consider units. Let's talk about this example, okay? If you were to purchase a $1 million property, now properties cost more or less, right? But I just want to make it somewhat realistic depending on where you live, about $1 million, okay? If you're putting 5% down, your loan amount would be $950,000. After your principal, interest, taxes, and insurance, you're looking at a payment of $8,286.29, okay? Now, let's take a look at what it would normally have costed you about 2 months ago, before this program started to roll out. You needed 20% down. Now 20% down, your loan amount is $800,000. Your principal, interest, taxes, and insurance puts you at about $6,802, okay? One of the main differences, besides the loan amount, which makes the payment lower, is that mortgage insurance, if you're not putting 20% down, you are subject to mortgage insurance. Now, this is an example of using 0.55% of mortgage insurance. Your mortgage insurance can be higher or lower depending on your credit score. The higher your credit score, the better. And also, if you put down more than 5%, mortgage insurance can be lower as well, okay? So the difference between this scenario and 5% down is about a difference of $1,484 per month. You're paying more on this side, okay? However, on this side, you're paying $150,000 more, okay? This is probably not realistic for some people that can otherwise afford the higher payment. Now, keep in mind, you live at this property, right? So if all units are being rented for about $2,000, the other 3 units are $2,000, your difference, if you own or occupy, is about $2,286. So this makes it very realistic for you, for a lot of people to be able to afford that payment, okay? If you were to go this route, you would actually produce income of almost $1,200 on this side, okay? But you need $200,000 plus closing costs. While on this side, you need about $50,000. So it makes it more realistic. Of course, if you can afford this side, we're here to help you with that as well. But if you cannot, then this makes it very realistic for most of you, okay? A few other things to consider. Properties have typically gone up in value. Rates are the highest they've been in probably the past 20 years. So you got to keep in mind that rates are likely to go down. So as rates go down, your payment goes down, right? So that makes the amount you're paying even lower, okay? Also, one other thing to consider, mortgage insurance. As your property goes up in value, when you have 20% equity, about 20 to 22% equity, you can remove mortgage insurance, which allows you to remove this $435 out of your mortgage payment that you'll no longer be responsible for. So that is also a benefit of a conventional loan. The other thing to consider is that there are tax benefits to homeownership, such as being able to write off your mortgage interest, your property taxes, your insurance, to depreciate the cost of the property or the value of the property on your taxes. Also, if you're a business owner, business use of home is also a tax benefit. So Carlden Lainfiesta, the Mortgage Fiesta, trying to make your home payment affordable, live as of this week, 5% down conventional for 2 to 4 units. Give me a call and I'll help you close. Thank you.